January 28, 2026. The US dollar index has breached a critical support level that has held firm through three separate tests since mid-2025. After temporarily breaking below 96 on January 27th, the dollar now appears positioned to complete its third major leg down since peaking in 2022, the exact moment when precious metals bottomed and began their historic advance. This inverse relationship between dollar strength and metals prices isn't theoretical. It's a proven mathematical correlation observable across 2 decades of market data. The significance of the 96 level cannot be overstated. This represents the average DXY strength since 2000, making it a critical psychological and technical pivot point. The dollar currently trades slightly above this long-term average, but the trajectory is unmistakably downward. Despite the Federal Reserve holding rates steady at today's meeting, Chairman Powell's language makes abundantly clear that the next policy action will be rate cuts, not increases. When you layer weakening demand for U.S. debt, which continues expanding toward $40 trillion, with the Federal Reserve resuming bond purchases in December 2025 after a brief pause, plus elevated geopolitical uncertainty directly involving the United States, capital flows are decisively moving out of dollar-denominated assets. Part of this dynamic is explicitly by design. President Trump has publicly stated that a weaker dollar benefits the American economy by making exports more competitive and tourism more attractive to foreign visitors. Setting aside political perspectives, the mathematical reality is straightforward. The dollar is entering a sustained weakening phase driven by both policy intention and cyclical forces. The currency cycle alone suggests significant downside as the dollar mean reverts toward its historical average. As this breakdown unfolds, precious metals are responding exactly as expected. Gold has decisively broken through what some analysts prematurely called a blow-off top on Monday, while silver has established strong support well above $100 per ounce. The Monday intraday high of $117.70 now represents the next resistance level to overcome, with $130 appearing as the subsequent target once that threshold is breached. The market is behaving precisely as it should during dollar weakness, metals appreciating as the denominator depreciates. The historical precedent for what comes next is instructive. The last time DXY broke down from the 96 level occurred between June and December 2020, when it rapidly declined to 90. While circumstances differ somewhat between 2020 and 2026, the technical setup remains remarkably similar. If precious metals replicate their 2020 performance during the coming dollar decline from 96 to 90, we could reasonably expect gold to appreciate another 10%, reaching approximately $5,900 per ounce, while silver potentially advances 49%, bringing prices as high as $168 per ounce. These aren't speculative targets divorced from reality. They're projections based on observable historical relationships between dollar weakness and metals appreciation. The question that separates conservative projections from crisis scenarios is simple. What happens if the dollar breakdown doesn't stop at 90? Historical analysis suggests the dollar could return to the 87 range seen in 2011, but what if the decline extends further as a consequence of what Chairman Powell correctly described today as unsustainable debt trajectory? To understand potential outcomes, we need to examine real-world examples of currency destabilization in developed economies. Not theoretical models, but actual case studies of what happens when major currencies fail. The first instructive example is Turkey, a developed economy with substantial industry, tourism infrastructure, and educated workforce. Yet it suffers from crippling inflation that has devastated economic development and destroyed the financial futures of both young people struggling to establish themselves and retirees who've watched life savings evaporate. The Turkish lira has lost over 80% of its value versus the US dollar in just 5 years. 3 factors drove this collapse, each offering cautionary lessons for other fiat currencies. First, President Erdogan insisted on cutting interest rates despite rising inflation, a controversial run it hot strategy intended to stimulate growth. It backfired catastrophically as citizens borrowed money essentially for free, considering inflation exceeded interest rates on loans, then used that capital to purchase assets, driving prices across the board. Second, markets lost faith in Turkish debt. Whether through forcing rates lower or dismissing central bank officials who wouldn't cooperate, foreign bond investors lost appetite for Turkish lending, ultimately forcing the government to fill spending gaps by creating new money. Third, things deteriorated so severely that the government enacted measures mandating local currency use for certain transactions, forced currency usage representing one of the first indicators of collapse. Yet even in this environment, a thriving gold and silver market persists in Turkey, arguably more developed than American precious metals markets out of necessity. To navigate currency failure, many Turkish citizens save in gold, silver, US dollars, and euros. The critical lesson: gold and silver savers emerged from this crisis strongest, while those who trusted the local fiat currency were completely wiped out. Lebanon provides an even more severe example, a country that has moved beyond the Turkish situation into near total currency collapse. The Lebanese pound is essentially worthless, used only for small transactions like coffee, cigarettes, or basic pharmacy items if available. The currency is functionally dead, replaced by the US dollar for all significant transactions. For Americans facing potential dollar failure, this suggests the necessity of identifying alternative fiat currencies, perhaps Swiss francs or currencies that don't yet exist, to facilitate transactions when the primary reserve currency fails. In Lebanon, as in Turkey, precious metals play a major role in personal savings for those who can afford it. In a world where no currency maintains the rock-solid reliability the US dollar once possessed, the only remaining option for long-term wealth preservation becomes gold and silver, later converted to usable currency on demand when transactions require it. This isn't a Mad Max scenario with government soldiers confiscating private metal holdings. It's the observable reality in Turkey and Lebanon, proof that gold and silver can protect wealth during currency destabilization. And this trajectory threatens not just the United States, but Europe, Japan, Canada, and other developed economies carrying unsustainable debt burdens. While physical precious metals provide wealth preservation during currency crisis, mining stocks represent a different opportunity: the potential for substantial capital gains in fiat currency terms while that currency still maintains purchasing power. The mathematics of mining stock leverage relative to physical metal prices create asymmetric upside that sophisticated investors are increasingly recognizing. Understanding this leverage mechanism is critical for anyone considering exposure to the mining sector. Historically, silver mining stocks appreciate at rates 1.5 to 2 times faster than the physical metal itself. The mechanics are straightforward. If silver rises from $100 to $110 per ounce, a 10% gain, mining stocks should theoretically increase 15-20%, bringing a $100 share price to $115 to $120. This leverage exists because mining companies generate leveraged exposure to commodity prices through operating margins. When silver prices rise, profit margins expand dramatically because fixed costs remain constant while revenue per ounce increases. However, something remarkable has occurred during the current silver advance that creates extraordinary opportunity. Over the past month, silver has appreciated approximately 43%, yet the SIL Silver Mining ETF has advanced only 32%, far below the expected 65 to 86% gain that historical leverage ratios would suggest. Expanding the time frame reveals even more dramatic undervaluation. Over the past year, silver has surged 276%, while SIL has advanced only 242% compared to expected gains of 450% based on traditional leverage multiples. This divergence suggests that if silver merely maintains current price levels, even after potential pullbacks, silver mining stocks remain extremely undervalued relative to historical norms. This is the analytical framework behind statements from investors like Peter Schiff claiming miners are cheaper now than they were a year ago, despite substantial price appreciation. The valuation isn't based on absolute share prices, but on the relationship between mining stock valuations and underlying commodity prices. Legendary commodities investor Rick Rule reportedly sold 80% of his physical silver holdings to purchase silver mining stocks, an aggressive repositioning based on recognizing this valuation gap. His logic is sound. If silver supply is tightening due to industrial demand while inventories deplete, the value of companies extracting that increasingly scarce commodity should appreciate dramatically. As the physical silver market experiences continued pressure from industrial consumption, capital rotation from overvalued technology stocks into undervalued mining equities could drive substantial repricing. The case for mining stocks in 2026 is particularly compelling because the typical outperformance hasn't yet materialized despite perfect fundamental conditions. As physical silver markets face genuine shortage dynamics, investor recognition of mining stock undervaluation relative to metal prices should trigger valuation adjustment. This creates a scenario where mining stocks could deliver leveraged gains both from continued silver appreciation and from multiple expansion as the sector catches up to historical valuation relationships. However, critical caveats exist. Mining stocks carry significantly higher volatility than physical metal. Individual companies face operational risks, jurisdictional uncertainties, management execution challenges, and capital structure vulnerabilities that physical metal doesn't possess. The strategy shouldn't involve selling physical holdings to buy miners. Physical metal represents long-term wealth preservation, while miners offer tactical capital gain opportunities. A balanced approach involves taking profits from mining positions during rallies and rotating some of those gains back into physical metal to build long-term holdings, recognizing that over extended timeframes, physical metal tends to outperform mining stocks despite shorter-term leverage advantages miners provide. While short to medium-term dynamics favor mining stocks due to the leverage gap discussed previously, long-term performance data reveals a different story that every investor must understand before allocating capital. Since the launch of the SIL Silver Mining ETF, physical silver has appreciated 555%, while the mining stocks represented by that ETF have gained only 155% over the identical time frame. This dramatic performance divergence contradicts the short-term leverage advantage miners typically enjoy and reveals fundamental truths about commodity investing. Several factors explain this long-term underperformance. First, mining companies face continuous operational challenges that physical metal doesn't experience. Permitting delays, labor disputes, geological uncertainties, equipment failures, cost inflation for inputs, and countless other variables that can destroy shareholder value even during favorable commodity price environments. Second, management teams vary dramatically in competence, capital allocation discipline, and shareholder orientation. Poor management can squander even the most favorable commodity cycles through ill-timed acquisitions, excessive debt, or operational incompetence. Third, mining companies require continuous capital investment just to maintain production levels due to ore grade decline and reserve depletion. Unlike physical metal that simply sits in secure storage appreciating with price movements, mining companies must constantly reinvest capital to replace depleting reserves and maintain production capacity. This creates a treadmill effect where significant portions of free cash flow must be directed towards sustaining current operations rather than returning capital to shareholders. Fourth, during severe market dislocations or liquidity crises, mining stocks can experience violent sell-offs uncorrelated to metal prices as investors flee risk assets regardless of fundamentals. Physical metal, particularly in allocated storage or personal possession, doesn't face this liquidity-driven volatility. During March 2020, for example, mining stocks crashed alongside broader equity markets despite physical metal remaining in demand. The strategic implication is clear. Physical metal should form the foundation of precious metals exposure, serving as long-term wealth preservation and monetary insurance. Mining stocks should be viewed as tactical positions to capture leverage during favorable phases of commodity cycles, with disciplined profit taking as prices advance. The optimal approach involves rotating gains from mining positions back into physical metal periodically, building the permanent core holding while using miners for capital appreciation during rallies. This also explains why sophisticated investors maintain exposure to both asset classes, but with different purposes and time horizons. Physical metal protects purchasing power across decades and even generations, surviving currency crises, political upheaval, and systemic financial disruptions. Mining stocks provide opportunities for fiat currency gains during commodity bull markets, but require active management, research into individual companies, and willingness to accept significantly higher volatility and risk in exchange for potential leveraged returns. For investors deciding to allocate capital to mining stocks despite the risks and volatility, proper due diligence becomes absolutely critical. The mining sector is littered with promotional schemes, poorly managed companies, and value traps that can destroy capital even during favorable commodity price environments. Arizona Metals serves as cautionary example, down nearly 50% in the middle of a precious metals bull market, with obvious red flags in financial health and technical performance visible through basic analysis. Effective research requires examining multiple dimensions of mining company quality. Financial health metrics come first: debt levels relative to enterprise value, free cash flow generation, operating margins, and capital efficiency ratios. Companies with excessive leverage face bankruptcy risk if commodity prices temporarily decline, while those with strong balance sheets can weather volatility and potentially acquire distressed competitors during downturns. Production metrics matter equally. Reserve life, the number of years of production supported by proven and probable reserves, indicates sustainability. All-in sustaining costs, AISE per ounce, determines profitability at various commodity price levels. Companies with AISC below $20 per ounce generate substantial margins at current silver prices, while those with AISC above $25 face compressed margins vulnerable to price volatility. Growth profiles, whether through organic reserve expansion, development projects, or strategic acquisitions, separate companies positioned for production growth from those facing declining output. Jurisdictional risk cannot be ignored. Mining operations in stable jurisdictions with clear property rights and reasonable tax regimes offer significantly lower risk than operations in countries with history of expropriation, arbitrary regulation changes, or political instability. A mine in Nevada or Canada carries dramatically different risk profile than identical operations in certain African or South American jurisdictions, regardless of ore grades or reserve sizes. Management quality assessment is perhaps most challenging but critically important. Track records matter. Have executives successfully developed projects on time and budget previously? How do they allocate capital between dividends, debt reduction, and growth investments? What's their insider ownership stake and compensation structure? Management teams eating their own cooking through significant personal shareholdings typically make better decisions than those compensated primarily through options and salaries regardless of shareholder returns. Comparative analysis across multiple companies helps identify relative value. Instead of analyzing single stocks in isolation, comparing peer companies across these dimensions reveals which offer superior risk-adjusted return potential. This is where analytical platforms become valuable. The ability to screen hundreds of mining companies simultaneously across financial, operational, and valuation metrics. Then comparing top candidates directly identifies opportunities that manual research might miss. The ETF versus individual stock decision also requires consideration. Mining ETFs like SIL provide diversified exposure, reducing individual company risk, but also dilute returns through inclusion of poorly performing companies and management fees. Concentrated portfolios of individually selected miners offer higher potential returns but require substantially more research and carry higher risk if selections prove poor. For most investors, a blended approach, core ETF position for baseline exposure plus concentrated positions in highest conviction individual companies, balances diversification benefits against potential for alpha generation through selective stock picking. Establishing realistic price targets for precious metals requires balancing historical relationships, current supply demand dynamics, and policy trajectories while acknowledging inherent uncertainty in financial forecasting. For the immediate phase corresponding to dollar decline from 96 to 90 on DXY, the historical framework suggests gold reaching $5,900 per ounce and silver potentially hitting 168. Targets derived from replicating percentage gains observed during the 2020 dollar breakdown from identical levels. However, these represent near-term objectives rather than cycle peaks. The broader bull market likely extends well beyond these levels based on structural factors, ongoing currency debasement, accelerating industrial silver demand, depleting above-ground inventories, and expanding central bank gold purchases. Conservative intermediate targets place gold at $7,500 per ounce and silver at $150 as starting ranges for the next analytical phase. These aren't endpoints, they're waypoints where market reassessment becomes necessary before establishing subsequent targets. The ultimate cycle peaks remain uncertain and depend on factors impossible to predict precisely: the extent of currency debasement, severity of potential financial crises, policy responses to economic stress, and timing of demand destruction if prices rise sufficiently to impact consumption. The gold to silver ratio currently suggests silver may have more upside relative to gold than originally projected, potentially driving the ratio below historical averages if industrial demand continues intensifying while supply remains constrained. Flexibility and continuous reassessment are essential because conditions evolve rapidly. Anchoring to specific price targets established months or years ago ignores changing fundamentals. The most effective approach involves establishing ranges rather than precise numbers, monitoring whether fundamental conditions supporting appreciation remain intact, and adjusting expectations as new information emerges. In markets experiencing structural regime change rather than cyclical fluctuations, traditional technical analysis and historical patterns provide guidance but not certainty. Risk management becomes paramount during this uncertainty. Position sizing should reflect individual risk tolerance and overall portfolio construction. For most investors, precious metals, both physical and mining stocks, should represent meaningful but not dominant portfolio allocation. Exactly what constitutes meaningful varies by individual circumstances, but general guidelines suggest 10 to 30% precious metals exposure for those convinced of the thesis, with higher allocations only for those with deep expertise and high risk tolerance. Within precious metals allocation, the split between physical and miners requires careful consideration. Physical metals should dominate for risk-averse investors prioritizing wealth preservation, perhaps 70-80% physical, with 20 to 30% allocated to miners for growth potential. More aggressive investors comfortable with volatility might flip this ratio, accepting higher risk for potentially amplified returns. Regardless of split, maintaining both exposures provides balance. Physical metal protecting against worst-case scenarios while miners capture leveraged gains during favorable phases. Stop losses and profit-taking protocols prevent emotional decision-making during volatility. Establishing in advance the price levels or percentage gains that trigger partial profit-taking in mining positions creates discipline. Similarly, determining maximum acceptable drawdown percentages before reducing positions prevents holding through catastrophic declines hoping for recovery. These mechanical rules don't guarantee optimal outcomes, but they prevent the worst decisions driven by fear or greed during market extremes. The overarching principle: conviction in the precious metals thesis should drive meaningful allocation, but not reckless concentration. Even the highest probability scenarios carry execution risk, and markets can remain irrational or manipulated for extended periods. Position sizing that allows sleeping comfortably regardless of short-term price action, combined with disciplined rebalancing and profit-taking, offers the best probability of capturing the opportunity while managing inevitable uncertainty. We find ourselves at a remarkable juncture in financial markets where multiple structural forces converge to create conditions favoring precious metals, appreciation on time frames ranging from months to potentially decades. The dollar breakdown below 96 on the DXY represents not merely a technical level violation, but confirmation of policy trajectory, cyclical forces, and fundamental weakening in the reserve currency that has anchored global finance for 3/4 of a century. The case for precious metals rests on observable realities rather than speculation. Central banks globally are diversifying away from dollar reserves, evidenced by record gold purchases. Industrial silver demand accelerates through irreplaceable applications in solar panels, electronics, EVs, and defense systems, while above-ground inventories deplete. Governments face mathematical impossibility of servicing debt through taxation alone, making debasement through inflation the only politically viable path. These aren't predictions, they're existing conditions that logically support higher metals prices. The mining stock opportunity adds another dimension for those seeking capital gains rather than purely wealth preservation. The historical leverage relationship between miners and metal prices hasn't manifested during this rally, creating valuation gaps that sophisticated capital is recognizing. As this recognition spreads, capital rotation from overvalued equities into undervalued miners could trigger the catch-up performance that fundamentals justify. This isn't guaranteed. Individual companies can fail even during sector bull markets, but the sector as a whole appears positioned for substantial appreciation if metals maintain current trajectories. Risk acknowledgement is equally important. Markets can experience violent corrections even during secular bull markets. Manipulation continues, particularly around options expiry and critical technical levels. Geopolitical developments could temporarily strengthen the dollar despite structural weaknesses. Individual mining companies face operational risks that can destroy value regardless of commodity prices. These risks don't invalidate the thesis, but they demand respect through proper position sizing and risk management. The strategic approach for serious investors combines physical metal for core holdings with tactical mining positions for capital appreciation, disciplined profit taking to lock gains, and continuous reassessment as conditions evolve. Historical examples from Turkey and Lebanon demonstrate that precious metals protect purchasing power during currency crisis. Not theoretical scenarios, but observable reality in developed economies experiencing what could be America's future. The window for positioning at current prices may prove brief. Once mainstream recognition of the supply-demand imbalance and currency crisis scenarios reaches critical mass, prices could gap substantially higher with limited opportunity to acquire positions at rational levels. Sophisticated capital positions before crises, not during them. The dollar breakdown, mining stock undervaluation, physical shortage dynamics, and policy trajectories all point towards substantially higher precious metals prices. The question isn't whether this matters. The question is whether investors recognize the significance before markets fully reprice the new reality. For those convinced by the evidence, the path forward involves building positions systematically, managing risk professionally, maintaining discipline during volatility, and recognizing this as potentially a generational opportunity to preserve and grow wealth while the monetary system undergoes structural transformation. The time to act is before the crowd recognizes what's happening, not after prices have already adjusted to reflect the new paradigm.